Hi everyone, welcome back to Saheb Academy. Today in this video of material costing chapter, we are going to cover one more method of pricing the issue of materials from the warehouse, and the name of this method is standard price method. Okay, the name says itself. Here we are going to have something called as standard price. What do you mean by standard price? Standard price means it is a price that has been set up by the organization through some parameters, right? And standard price means a fixed price, kind of like, yeah, it's not going to change, right? So that's the entire concept over here, that we have to calculate a standard price and then we are going to fix that price, and all the materials which will be going out from the warehouse, they will go at this price only, this fixed predetermined price. You are not going to see at what price we have purchased them and all. No, nothing like that. Just send out all the materials at a standard price. That's the entire concept. Okay, but here there is a bit of standard costing, like we have to calculate standard price and then we have to compare this with the actual data. Yeah, little bit extra things are there that we are going to understand in very much detail. Okay, so let's begin. Now see here, let's just read this and understand. Under this method, materials are priced at some predetermined rate. Yes, beforehand itself, we will determine a rate. We will fix a rate, okay, which is called as a standard price. Of standard price, irrespective of the actual purchase cost of the materials. It doesn't matter at what price you purchased, okay, because whatever that will be going out through the warehouse, we are going to, value that, price that at a standard price. Fine. So standard cost or standard price is usually fixed after taking into consideration the current market price, okay, of the materials and anticipated market trends, okay, demand, supply, all these things. Fine. Then see, this is the thing, okay, you will calculate the standard price, you will send out the materials on standard price. Fine. And then at last, in almost all of the question of standard price method, they will ask you some extra information. They will, ask, and always, even if they don't ask, you have to do this. You will have to compare, you'll have to compare the standard price with the actual price, okay? And you will have to calculate whether you have made a loss or profit, okay? See here, the standard price is compared with the actual price. Actual price means the price which you have actually paid to purchase the material. Standard price is the price that you fixed by way of formula. Okay, right. So if actual price is more than standard price, yeah, standard price is a budget price, it's budgeted. Actual price is what has actually happened, right? So if actual price is more, that means you have made a loss. Okay, you thought it would cost 20 rupees, but it has got, let's just say, 25 rupees. So 5 rupees is the loss. Okay. And if actual price is less than standard price, yeah, you thought that standard price would be 20, but actual price is 80. If this happens, then you have made a profit of 2 rupees. Is that clear? So now this profit or loss on material is termed as material price variance. Okay. What is this variance? Variance is nothing but just a difference between the budgeted data and the actual data. Yeah, what you forecasted and what has actually happened. That's called variance, the difference, the variation. Is it clear? Right. So now see here the formula of material price variance. How will you, calculate this? It's really simple. At last, what will be left now in the store's ledger, the closing stock, the quantity I'm talking about, that quantity you are going to take over here, closing stock units, okay, into standard price, the price which you have set up, okay, the fixed price which you have set up. Now I told you here 20, so that 20 you will take. Closing stock, let's just say, is 100 and standard price is 20. So 100 into 20, that will give you, 20,000, right? So 20,000 will be what? It will be the closing stock value at a standard price. Is it clear? Yes. So you will take this, okay, and subtract with the closing stock value which is actually there in the store's ledger. In the store ledger, in the balance column, what will happen at last? That will be there at an actual value. Okay, so you will take that and you will subtract. You will find out what's the difference between both the things, the standard data, yeah, the budgeted data, and the actual data. So that will give you the material price variance. Okay, you will have to calculate this at last. Fine. And then moving on, how to calculate standard price. See, it's really simple how to calculate standard price. First, what you have to do is you have to take the opening stock value. Okay, it will be given to you in the question, don't worry. You will have to take opening stock value, or sometime what happens is they give you closing stock value, okay, of previous period, which is opening stock for the current period. Okay, so that you will take. Is that clear? And then, you know, either you have to add or subtract depending upon what is there in the question. If there is a debit balance of material variance, you will have to add. Debit balance means loss. Okay, this thing, right? Debit balance means loss on material variance. If there is a loss, then you have to add. If there is a profit, if there is a credit balance of material variance, you have to subtract. Okay, depending upon the question, you have to do this. Fine, you will do this and you will divide by the opening stock units. This is opening stock value, the entire value, the amount, and you will divide by the units, the quantity. Okay, so this is the formula. Don't worry, it might seem a little bit complicated over here. We'll just go to a problem and you will see how simple this is. This is nothing. Okay, it's very easy. All right, so let's go to a practical question and let's see this. Now see, here we have a practical question of standard price method. Let's just read this question and then simultaneously let's just understand how to solve this. It's really simple. See here, stocks are issued at a standard price and the following transaction occurred for a specific material. Okay, here we have the transactions, and then at the below here they have given us some extra information and some extra requirement. Okay, so we have to do everything. See here, they are saying the debit balance of price variation on 1st January was rupees 20. Okay, so here they are giving you the material price variance of the previous period. Okay, of the previous month maybe or previous year. Okay, so they are saying it is rupees 20. But now you have to understand there are two types of variance. Yeah, the variance can be favorable or unfavorable. Is that clear? It can be favorable or unfavorable. Favorable we also call it as profit, and unfavorable we also call it as, you know, loss or adverse. Is it clear? So now here they are saying debit balance. Debit balance means you always need to understand it's a loss. Debit balance means loss, credit balance means profit. Is that clear? Okay, we got that. So now show the stock account for the material for the month of Jan. That means we have to prepare the store ledger account, indicating how you would deal with the difference in material price variance. Okay, at the end of the month of January also, again we have to calculate the material price variance. This 20 rupees which they have given, this is of the previous month. Okay, maybe of the December of the previous year, right? Now at the end of January also, again we have to calculate material price variance. We'll do that. We know the formula how to do it. It's very simple. We are going to do that when preparing the profit and loss account for the month. Okay, so they are saying how you are going to deal when you are preparing the profit and loss account also. Okay, fine, we'll comment everything. Now let's begin. So how do you begin the question of standard price method? Let me tell you, it's very simple. First you need to calculate standard price. Okay, so we have the formula for standard price. Let's just see. Opening stock value, right? First we need opening stock value. So just check whether we have opening stock value. Yes, we do. See here, 1st January, opening stock 10 tons at rupees 240 per ton, right? So just multiply and calculate the value. 10 is the quantity, ton, multiply by 240, which is the price per ton. So that's equal to 2400. 2400 is the what? It is the opening stock value, the amount. And then you have to add debit balance of material variance. But if there is no debit balance of material variance, then there will be a credit balance, right? Either there will be a loss or profit. So you have to see what you have in the question. Here we have debit balance of price variance, right, of rupees 20. So we are going to add, you know, 2400 plus 20. Is it clear? Debit balance, debit balance you have to add. Is it clear? Okay. And then we have got 2420. You have to divide it by what? Opening stock units. Okay, opening stock units are 10 tons. So divide by 10, that's equal to 242 rupees. So 242 rupees is what? 242 rupees is the standard price. Okay, see the calculation over there. Really simple and straightforward. Okay, standard price is equal to, first we calculated the opening stock value and then we added the debit balance of material price variance rupees 20, then we divided the entire thing by 10, which is the opening stock units, we got the standard price. So all these issues that are happening now on 5th of Jan, 12th Jan, 19th Jan, 26th Jan, 31st Jan, all these will be going out at this fixed predetermined price. So let's just do that. It's really simple, and the way of preparing the store ledger is exactly like replacement method. Okay, we'll combine everything fine that way. There are no different lots, everything will be combined. Right, so let's begin. See here, stores ledger. Okay, 1st January we took the opening stock, yeah, 10 tons, 240 per ton. Okay, clear, easy. And then on 4th January what happened, we have purchased 5 tons at 260. So that will come in receipt column. You all know 5 into 260. Let's just do that in calculator. That's equal to 1300. Clear, 4th Jan, fine. So now this thing you have to add with the previous balance and take the answer over here. See here, 10 plus 5, that's 15, and 2400 plus 1300, that's 3700. Clear? And remember, same like replacement method, in the balance column you will not take the price, it's not required, the rate column. Is it clear? Yes. Then next transaction, see here, 5th of January we have to issue 3 tons. How will you issue 3 tons? Are you going to follow FIFO, LIFO, replacement method, something like that? No, nothing. You just have 242. You will send everything out at 242. See here, on 5th of January we are sending out 3 tons. Yeah, we have 15 tons. Easily we can send out 3 tons at the price of 242. Clear? So 3 into 242, that's equal to 726 rupees. Okay, and then you are going to subtract 15 minus 3, 12, 3700 minus 726. Let's just do that. 3700 minus 726, that's equal to 2974. Clear? Easy now? Yes. Next transaction, see here, 12th of January we have to issue 4 tons. Can we do that? Of course. See here, we have 12, we just have to issue 4 on 12th of January. So we did that at 242 only, the same fixed predetermined price, standard price. Okay, so 4 into 242, that's equal to 968. Okay, that's the issue. Now you have to subtract 12 minus 4, that's 8. 2974 minus 968, that's equal to 2006. Clear? Okay, and then on 13th of January purchase 3 tons at rupees 250 per ton. Now whenever you will have a purchase, directly take in the receipt column as usual, nothing special about that. 13th January 3 tons you have purchased, right? 250 is the price per ton. If you multiply, you get 750. Clear? So now just add it. 8 plus 3, that's 11. 2006 plus 750, that's 2756. Clear? Easy. After that, on 19th of January we have to issue 4 tons. Easy. We have 11 tons. Easily we can issue. See here, 4 tons we have issued at standard price only. 4 into 242, the same thing, 968. So 11 minus 4, that's 7, and then 2756 minus 968, that's equal to 1788. Let's just do that in calculator. 2756 minus 968, that's equal to the same thing. Okay, 1788. Clear? So this happened on 19th of Jan. So on 19th of Jan, what do we have? We have 7 tons at this price. Okay, I mean the entire amount, the value. And remember, whatever is there right now over here, these are actual values. Okay, these are not standard price. Standard price are this, standard value and standard price. Here everything is at actual. Remember that. Okay. Then next we have 26th Jan issued 3 tons. So can we do that? Yes, we have 7 tons in the balance. So on 26th of Jan we are issuing 3 tons and at standard price only. So 3 into 242, that's 726. So 7 minus 3, that's 4. 1788 minus 726, that's 1062. Clear? Easy. Moving on, then we have 30th January transaction, purchase 4 tons at rupees 280. So let's just take that in the receipt column. See here, 30th Jan, 4 into 280, that's equal to 1120. Okay, so just add that in the balance. 4 plus 4, that's 8. 1062 plus 1120, let's do that in calculator. 1062 plus 1120, that's equal to 2182. Clear? Easy. After that, on 31st January, we have to issue 3 tons. So let's just do that at the price 242, the standard price here, 31st Jan. We have 8 quantity. From that, we have issued 3 at 242. So that's 726 only. And just subtract 8 minus 3, that's 5. 2182 minus 726, that's equal to 1456. Clear? Easy. Now, after this, now here, your store ledger is over. Now you have to understand some things. Again, I'm repeating these things. Okay, see here, these are at standard value. Yeah, the issues which you have done, they have gone out at a standard price and they are at standard value. Clear? But the balance column, everything is recorded over here at the actual values, whatever you have purchased in actual. Okay, so what's the closing stock over here according to the store's ledger? According to the store's ledger, the inventory which you have over here at last, the closing inventory, the closing stock is 5 tons, isn't it? Yes, it's 5 tons and the price is 1456. Now this is the actual price. This is the actual value. Is it clear? Yes. So now they are asking, see here, indicating how you would deal with the difference in material price variance. So how do we calculate material price variance? Let's just see the formula. Yeah, we have to calculate. They have said at the end of January also you have to do calculate. Material price variance formula is closing stock units. Do we have closing stock units? Yes, we have closing stock units. See here, it's 5, isn't it? It's 5. This is closing stock units, right? Into standard price. What's standard price? Standard price is 242, isn't it? So 5 closing stock units into 242, that's equal to 1210. So this is closing stock value at a standard price. Okay, so this you have to compare with what? This you have to compare with the actual value of closing stock, what you have actually paid, okay, for the inventory, right? So 1210 minus what? Minus 1456. Yeah, 1456, this is the actual value. Okay, so if you subtract, see, understand, what did I say? If the actual price is more than the standard price, then you have a loss. Okay, and that's the case in this question, isn't it? This is the standard value and the actual cost is more. The actual value is more, 1456. You budgeted that it would cost you this much, but it has costed you more, 1456. Is it clear? So there is an unfavorable variance over here. Let me just show you. See here, valuation of closing stock at a standard price, we just did 5 into 242, 1210. Yeah, and then valuation of closing stock as per store ledger. This is the actual data. Let me just write that over here. Okay, this is actual data. We got that from over here. Okay, actual data, and then we compare this. Yeah, standard with the actual. Standard is less than the actual. Yeah, actual is more. Actual is more. Actual price is more than the standard price. So we have a loss. Loss of how much? Loss of how much? Minus 1456. Right? So that's equal to 246. There is an unfavorable variance of 246. Okay, see here, but you will not take it in negative and all. See here, how will you write this? Material price variance is equal to the standard value minus the actual value. So rupees 246 negative we got. Yeah, you can easily understand. Yeah, if standard is less, then it's negative. So we call that as adverse or unfavorable variance. Fine. Now this 246 will go where? It will be charged to profit and loss account. Is it clear? That's how simple it is. And always in all the question of standard price method, if the data is available, then you will have to calculate all this at last. Fine. So this is the thing. It's really simple and straightforward. You just need to understand the formulas. It's really simple. Here we are doing nothing but comparing the closing stock at a standard value and at the actual value, and we are calculating the material price variance. And to calculate the standard price, what are we doing? We are just taking the opening stock value, right? And if there is a loss, we are adding it. If there is a profit, we are subtracting it. Okay, of material variance I'm talking about. And then we are dividing it by opening stock units. And remember, in some questions They will not give you opening stock value. They will say closing stock of December or something like that. Closing stock of December 31st is the opening stock of 1st January. So remember that. You will have to take that, okay, over here. So yeah, that's the thing. Fine. So that's all for this video. See you in the next video. Bye.